All right, day 36 of my journey to a $500,000 stock market portfolio. So as you can see, my total equity is now up to 93,457. Now the reason it jumped, two reasons. First, I transferred my RESP from CIBC to Questrade only because I wanted everything to be in one place, and obviously Questrade has better commissions than CIBC. For options, CIBC charges $6.95 flat rate plus $1.25 per contract. But Questrade charges $5 flat rate plus 75 cents a contract. So in the fixed portion, there's already a $2 difference, and then in the variable portion, there's a 50-cent difference. So if you have like 11 contracts, it adds up, and it adds up going into the trade and going out of the trade. So that's mainly the reason why I transferred to Questrade for the RESP, which is the Registered Education Savings Plan. So I'm going to include it in my total. Also, I made a $5,000 contribution to my TFSA. So that's another reason why the whole balance increased. And I'm $2,000 away from maxing out my TFSA. My goal is to max out my TFSA and RSP as much as I can, and then use my margin account. All right, so the last week was a really bad week. I was mostly trying to manage my losing trades because I had a lot of call spreads that started to go against me last week because the market just decided to go up in consecutive days. So a bunch of call spreads that I had open maybe 30 days ago just went against me, and I had to start managing them. Some of them are going to cost me a lot. So let's go through all my positions first, and then I'll explain what I did on each trade if I can. So first of all, in my margin account, I've got American Airlines. This is a covered call trade. So I bought 100 shares of American Airlines, and I sold a call option against it immediately. I did this a while back, but I bought this stock at about $31, I think, $31.50. And then it dropped to 25, 24. So I sold a call option at 27. At a 27 strike. But by doing that, of course, I risk losing my shares at 27. But I did that to collect some decent premiums, and I hoped that the stock would not surpass 27. And of course it did. So what I did when that happened is I kept rolling over the call option. So by rolling over means I buy back the same call option at 27, but then I sell the next month's call option at the same strike. And I do that for a credit. So even though I'm selling at a strike that's lower than my initial purchase price, I'm still collecting a credit, rolling over to the following month, hoping that American Airlines drops back down to 27. And even if it doesn't, well, I'm collecting credits every time I'm rolling over. So it sort of reduces my cost basis. So instead of actually saying that my cost on American Airlines was 31.5, it's actually 31.5 minus all the credits that I've been collecting since the beginning selling this call option. So the last trade I made on American Airlines has a call option that expires December 20th. You can see I collected 63 cents from that one, and then 34 cents from the previous, and then 30 cents, and then 12 cents. Box is a covered call trade as well that I've had a very long time now. Bought the stock at 20. It dropped down to 13, and then now it's back up to almost 17. And I sold a call option on it. The last one is expiring December 20th and collected 69 cents. So I'm not in trouble on this one because my strike is 20. So I'm not worried about losing my shares at a lower strike than my cost. But I'm not collecting as high premiums as I want to. But it's better than selling your shares at a lower price. Friday, I placed this iron condor trade on Chipotle Mexican Grill. It's a little bit tight. I mean, I took a put strike of 700 and a call strike of 775. So the range is not amazing, but I collected a good premium. I collected $175. Risking though, I'm risking the difference between 500 and 175. So I'm risking $325. But I can manage it whenever it goes against me. So if I feel like the trade goes against me, for example, if I feel like the stock is going to continue to go lower and hit my 700 strike, depending on how much time I have left in the trade, I might do nothing. But if I don't have that much time, let's say there's 2 weeks left and the stock, see, the thing is, when time goes by and nothing happens, I can close this whole trade for a profit. I don't have to wait till expiration. So there's different scenarios that could happen. If time goes by and this trade is still safe, then I'll close it for a profit, 50% profit, let's say. But then if it starts to go against me early, I still have time. I don't have to do anything. If time continues to go by and then it decides to come back in the right range, well, then I'll be able to close my trade early because time went by and the trade is inside my range. I can close the trade early. If it goes against me at the beginning, but then stays against me for a while and never comes back, and I have 2 weeks left, let's say, this is a 4-week trade. Let's say I have 2 weeks left, I'm going to start adjusting. I'm going to start bringing down, for example, if the stock went down, then I'm going to bring down the call side. Instead of being at 775, I can go down to 750 or 745. This allows me to collect more premium. So initially I collected 175. By bringing down the call side, maybe I'll collect an extra $50, let's say. And then I'll wait a few days. If the stock still doesn't go back in the range that I need it to, then I'm going to sell. Then I'm going to do it again. I'm going to bring the call side closer, collecting more premium. So basically, I accept that the trade is going against me, but instead of losing a max loss of $325, I can try to reduce that by bringing in the call side and collecting more premiums. And who knows, maybe it does come back up last moment, and then I would have collected, let's say, about $250 or even $300 in premiums, and then I can try to close the trade for $150 or $200 so that the overall trade becomes profitable. So it's not too scary if you can manage it early or correctly. So I've got this Dell covered call trade, 100 shares of Dell at 52.8. My main strike is 52.5 because that's the one I've been selling at since beginning. And right now I've rolled it over to December 20th. So I've had Dell for a while, but as you can see, I've collected $1.60, collected $1.82, collected 75 cents, collected $1.50. So all these premiums, I consider that as income or as a way of reducing my cost on Dell. But if I sell my shares of Dell at 52.5, then these premiums here would be considered profit. All right, so I had a call spread on DIA, which tracks the Dow Jones index, expiring December 20th at a 280 and 285 call. So my short strike was 280, but then of course this week everything's going up, so the 280 is becoming tested. So I decided to sell a put against it. Now I didn't have a put before. This was just a credit spread, a call credit spread. But because the call side was getting tested, although I do have a lot of time left, I have more than a month left, but I decided to sell a put just to collect some sort of premium. I collected about $54 from this. While the initial trade, I collected about $70. I decided to add a put spread to this trade and turn it into an iron condor and collected $54. So I added to the premiums that I collected. So I'm reducing the risk in this trade. Max loss is the difference between the spreads. So 500 minus the premiums that I'm collecting. So the more premiums I collect from this, the less my risk is. Now the idea is I don't have to wait till expiration, but now that my max profit is $120 something or $130 almost, as soon as I have a chance to close out the trade for half of that, so let's say $60, then I'll do that between now and December 20th if the stock comes back down a little bit. Goldman Sachs was a call credit spread. It started off as a call credit spread at 222.5, but of course it went against me this week and I have 3 weeks to go. So I decided to turn it into an iron butterfly. So I sold the put spread against it at the same strike as the call. So really, I have really no room for profit right now. I'm just trying to limit my loss, reduce my loss. So you can see I collected, initially when I sold the call spread, I collected about $40 or 40 cents per contract, but I sold 2 contracts. So I collected 40 cents, and then on the put side, I collected almost $1. And you can see the difference between my strikes is 2.5. So my max loss on this is 2.5. But I collected $1.40. So now my max loss is $1.10. That's the worst case scenario. But I still have time, so I might be able to close out the trade for less than 2.5. If I close it for 2.5, then I lose $1.10 on this trade. But because we still have time, it might come back down. It might fall at exactly 222.5. It might cross it. So the day that it's trading at 222.5 and the closer we are to expiration will be the lowest I can buy back this trade. So if I can buy it back for, let's say, $2, then I only lose 60 cents. If I buy it back at $1.50, then I lose 10 cents. But basically, by selling the put side at exactly the same strike as the call side, I went and collected the most premium I can collect to reduce my loss or my max loss on this trade. And I did this because everything was going up, financials, the whole market was going up, and I don't know what's going to happen. I don't know if it's going to continue to go higher or come back down. I don't know. I want it to come back down, but I don't know. So I just didn't want to be in too much trouble. So I wanted to reduce max loss on all these call spreads that are causing me trouble. See, I've got another call spread on the Qs here at 203. It's not in trouble yet, but it's getting close. It expires December 6th. So I still have a lot of time, but the Qs right now is trading at 201.23. So it keeps getting closer. So it's making me worried. I've got another one December 6th at 205. I've got another one December 6th at 207. So this one's safer, of course, but who knows what's going to happen. What if the market goes up consistently day after day for the next month? I've got another one on November 22nd. So this one is in 2 weeks at 208. So this one should be safer, but who knows? So I have one expiring in 2 weeks at 199. It started off as a call spread at a 199 strike. So obviously the Qs passed it. So I decided to turn it into an iron butterfly. So I sold the corresponding put spread on it to collect premiums to reduce my max loss. So my max loss on this starting out is a difference between the spreads here. So $3. I initially opened the trade collecting about $37 or 37 cents, sorry. So max loss is 3, I collected 37, so max loss is $3 minus 37 cents. And now, by selling that corresponding put spread, I collected about 60 cents. So now my max loss has been reduced to $3 minus 37 cents minus 60 cents. So now my max loss is about $2 on this trade, which is still bad, but hopefully I can try to close this trade. Instead of closing it for $3, I can try to close it for $2. So $2 minus the $1 in premium that I collected gives me a $1 loss. So most of these trades are going to be closed for losses, but I'm trying to reduce the loss on them. And how am I compensating for these losses? Well, I'm selling new credit spreads. I'm selling new iron condors, collecting premiums on them. These ones that I sold last month are causing me trouble because the market is going in the wrong direction, but I'm trying to reduce max loss. So you see, I've got an order on it already, a good till canceled order. I'm trying to sell it for $1.85. I'm trying to buy it back for $1.85. So my max loss is 3. I don't want to buy it back for $3. So hopefully, I still have 2 or 3 weeks to go. 2 weeks to go. So who knows? Ideally, I want the Qs to trade right now close to 199. That's what I want. It's trading at 201. It might go up a bit, but hopefully in 2 weeks it drops back down to 199. And as soon as it drops to 199 will probably be the best time to close the trade. Now the options will still have some time value in them. So of course, the further I am from expiry, the more premiums I'll pay, but I might not want to wait till expiry because I don't know where it's going to be on expiry. If ideally, I want this to be at 199 come November 22nd. That'll be the perfect scenario. I can close it out for nothing and probably turn it into a profitable trade, but it's obviously very unlikely. So I've got this iron condor on the Qs expiring November 29. So this one it started off as an iron condor. You can see that the put side is already profitable. See, it's showing me a profit here. So the put side is profitable, but the call side is a bit in trouble. Not that much, but a bit in trouble. I initially opened this trade for about $102. I can probably close out this whole trade for the exact same thing. So it wouldn't be a profit at all. But I want to turn it into a profit. My goal is not to trade to break even. My goal is to trade to make money. So what I could do for now, I won't do anything because it's still far from the 203 and the market already rallied up. So it's not expected for the market to continue rallying. It should drop back down a little bit. When it drops back down a little bit, then I could probably close this trade for less than what I sold it. So I sold it for 102. Maybe I can close it for $70 or $60. As time goes by, I have a better chance of closing this trade for less, unless the Qs start going past one of my strikes. So right now, the strike that's in trouble is the 203 call. If it continues to go higher, then I'm going to bring my put side higher. So I'm going to close the put side for a profit and then bring it closer, bring it maybe to 200, collect the premium there. And then by collecting a premium, I've reduced my max loss. My max loss on this is the difference between the strikes, so $4 minus the premium that I already collected. I collected $1.02. I'll probably collect another premium if I bring my put side higher. So Roku, I had a call spread on Roku at 160, expiring next week, November 15. So this one's going to be 100% profit. I'm going to let it expire worthless so I don't have to buy it back and pay commissions of $6. Right now it's trading at 122 and it's after earnings. So it's not going to rally up in 1 week from 120 to 160. I think it dropped from 140 to 120 after earnings. So it's very unlikely that it moves up from 120 to 160 in 1 week. So I'm just going to let it expire worthless so that at least I get 100% profit from this trade and I don't have to pay commissions to close it out. So I've got a Russell 2000 call spread expiring December 6th at a 1640 strike. Right now, the Russell 2000 is at 1598. So it's somewhat safe, especially that it already went up hard last week, but who knows, it might continue the rally. If it continues the rally at the same pace, then I'm in trouble. But obviously, if it trades normally and dies down a bit, then I could probably close this trade before December 6th for a profit. So this has a $5 risk, but I collected $85 or 85 cents initially. So I got to keep my eye on it. So I don't want this trade to get into too much trouble because my max loss is $415 right now. If it starts getting in trouble, then I'll have to sell a put against it to collect more premium. Got this call spread also on December 6th on the Russell 2000 at 1655, collecting 80 cents. Max risk is 420. I've got another one December 6th at 1665. So right now they look good. They look like they can be profitable, but depending on how the stock market moves between now and December 6th. So I initially had this call spread on the Russell 2000 expiring November 15 at a 1585 call strike. But of course, market surpassed it. The Russell 2000 surpassed it. So my way of reducing max loss was selling a put spread at the exact same strike of the call. So at 1585. So I turned this call spread into an iron butterfly to collect premiums and to help reduce max loss. But this this trade here is going to be a loser for sure, because as you can see, I collected $172 right now from this trade. My max loss is the difference, so $328. If I close the trade for $5 now, we still have a week to go. Ideally, I want the stock to trade at exactly 1585 or something close to it come November 15, so I can close it for less than $5. If I close it for $3 and I collected $178 from it, so my loss would only be $122. So it really depends where the Russell 2000 trades. I can hopefully try to close it for less. This one, November 29, is an iron condor. The call strike is 1610. Put strike is 1480. So the put spread is profitable, but the call side is getting tested, or it's already tested. We're 3 weeks away and I'm already at 1610. We're already trading at 1598 and my strike is 1610. So it's very close. So the only way this becomes profitable is if the Russell 2000 decides to come back down. But if the Russell 2000 continues the same pace and goes up, then this one becomes in trouble. What I'm going to have to do is I'm going to have to bring up the put side. The put side is at 1480. I'll bring it up maybe to 1550 or even 1575. Collecting more premium, reducing my max loss, but also giving myself an opportunity if the Russell 2000 comes back down before November 29, I can close it for a profit. So as you can see, I've got a lot of spreads to manage. This one's December 6th at a 1620, so it's also pretty dangerous. The put side is profitable, but I can bring it up. This one's November 29th, 1620 as well. I'm gonna have to do the same thing, probably bring up the put side. This one's December 13 at a 1630 strike. So as you can see, the call side is always the one that's in trouble right now because the market is going up. So I'm gonna have to bring up the put side to collect more premium and reduce the max loss. So SNC expires next week. This one, I'm gonna have to get my shares back. I won't be able to roll over the call option because there's no more extrinsic value left in the call premiums because it's deep in the money. SNC is trading at 26. My call option is 21. So what's going to happen most likely is November 15, I'm going to just get my shares back, or get my money back. So I'm going to buy back the call option to close, and I'm going to sell the shares on the market right away. So I'll get my money back. I'll be getting 2,100 basically. So on SNC, my profit on SNC would be all the premiums that I collected on SNC when I first got into the trade. But I'm actually going to lose 75 cents because I bought the stock at 21.75 and the last strike I sold was at 21. Since SNC is trading at 26 now, I'm going to have to lose my shares at 21. So I lose 75 cents, but I've collected enough premiums to hopefully compensate for the 75 cents. Anyways, I'm trying to stop doing covered calls on stocks right now. I want to do covered calls on ETFs like the Qs, the SPYs, the IWMs. So I'm just going to close out all my covered call trades on stocks whenever I can, and then do covered call trades on ETFs. And in my margin account, I'll be doing credit spreads. Got another one here at 31.40. This one's safer. If I can close it for a profit, I will, but obviously I can't right now. I might have to sell some put spreads against it. Even this one as well, the one at 3100, I might sell some put spreads against it, but I still have time, so I won't do anything right now. So you can see all these 3 iron butterflies on the SPX. These are all 3 credit spreads that expire November 15. The call sides got tested, so I decided to bring up the put side completely at the same strike to collect some premiums and reduce my max loss. Now these ones will be losers for sure. Now the idea is to make them less of a loser. Now the best way for me to close these trades is, or the best time for me to close these trades is when the SPX hopefully drops back down to, for example, on this one 30.50. On this one 30.70, and on this one 30.85 in the next week. Now the index usually closes one day before, so I need to close it before November 15. I need to close it November 14. I've got some more SPX, but these are the weeklies. I've got one at 31.20, but for November 29th, it's getting in trouble, but I still have time. If I will manage it, I'll sell put spreads against it. I've got one December 6th at 31.25. So as you can see, a lot of call spreads are getting in trouble just because the market went up like crazy. The last spread I sold, I believe, was December 9th. So yeah, this is the last call spread I sold on the SPX. Was at 31.70, December 9th. Hopefully this one should be a good one. Actually, this was an iron condor, because now I don't know what's going on. I don't know which direction the market is going. Usually I'm a contrarian, so if the market goes up, I believe that it's going to come back down, so I sell a call spread in that case. If the market goes down, I'll sell a put spread, believing that the market is gonna come back up. So that's what I did with all these call spreads. When the market was going up, decided to sell call spreads, but then it just keeps going up. So now all these call spreads are getting in trouble. Now the last call spread I sold was this one here, December 9th, at a 31.70 strike. So this one I hope should be safe, should become profitable. But because I don't know anymore what's going on, I decided to sell put spreads every time, so that I don't miss out on the premiums from selling the put side. If I had sold puts while I was selling these call spreads to begin with, I would have collected much more premiums from the puts because they would be all profitable right now. So I would have been in a much better position if I had sold iron condors instead of just call spreads. So that's why I sold an iron condor on this one, because I don't know anymore what's going on. I don't know which direction the market is going. So at least with an iron condor, I'm covered on both sides. If the market goes down, well, I sold the call side, so I got some profit there. I can adjust by bringing down the call side. I'll be in trouble on the put side, of course, but then I still have time. Depending when all this happens, if the market goes down early, I still have time. If it goes down towards the end of the trade, well, then I should have closed the trade before that, because time went by. So that means I was able to close the trade for less than what I sold it for. But at least I can profit from any direction and then adjust accordingly. So this buy here was a call spread. It started off as a call spread, but as you could see, I turned it into an iron butterfly because the call side got tested. So I collected a premium from the put side, and now I need the SPY to trade at around 308 come November 22nd for me to really make a profit from this. If not, I'm just trying to reduce max loss and try to close it for less than $4 or $3. My max loss on this is $3. I already collected about 50 and 30. So my max loss on this is $3. I already collected about $1.20, so 50 and 80, so $1.30. I already collected $1.30. So my max loss now is $1.70, but I don't want to lose on this trade, so I'll try to close it for $1.30, $1.50. And for me to close it for a profit, it needs to land at exactly 308. This is an iron condor that for sure I'm gonna have to start bringing the put side up, because as you can see, the call side is losing money. The put side is very profitable. So I'm going to start bringing it up closer, maybe to 300. Although I still have time. I still have until November 29th. Maybe it'll come back down. But with the way things are going, I think it's safer to bring up the put side, collect an extra premium. Plus, the put side, as you can see right now, is almost worthless. I'd be closing the put side for about 13 cents. So it's a good time to roll it up, collect more premium, therefore reducing max loss on this trade. And if the SPY comes back down a little bit, let's say 307, 306, 305, then I can close the whole trade out for profit. I don't have to wait till expiration. We've got another iron condor on the SPY, expiring November 29th at the same strike of 309 call. But the put side is even more profitable. It's a 287 put. So this one definitely, next week I'm going to roll it over. I'm going to bring up the 287 put because it's completely worthless. Yeah, I can close it for 6 cents. So I'm going to bring it up to collect more premium on this position. TLT, I turned it into an iron butterfly. It was an iron condor. My call side was completely profitable. It was at 145, I believe. So as you can see right now, it's trading at 134.91. So I closed down the call side. I brought it all the way down to the same strike as the put, turning it into an iron butterfly to collect as much premiums as I can to reduce my max loss in case it turns into a loser. But hopefully, I still have time. Hopefully TLT rebounds a bit, moves a bit towards 137, and I can close it for less. So let's see how much I've collected from TLT. See, that's the thing. I've got too much to manage now all of a sudden. All right, so I started off iron condor on TLT, collected 44 cents with a max loss of $1.50 minus 44 cents, so a max loss of $1.06. When I brought down the call side, I collected an extra 38 cents. So now my max loss is $1.50 minus 44 cents minus 38 cents. So now my max loss on this trade is 68 cents. So if I want to close this trade completely without losing anything, I could place an order to close this trade for 66 cents. But I want to turn it into a profitable trade, so maybe I'd rather close it for 33 cents and make a profit out of it. But it all depends where TLT is trading. But my max loss is 66 cents right now. So I had this call spread on Tesla at 330. Collected $1 from it. As you can see here, 442 minus 342. I actually had a chance to close it for 85 cents. So $15 profit, but of course after commission is not worth it, so I didn't. But then Tesla decided to jump up like crazy again, like it didn't jump up enough. And now it got tested completely, so I sold a put option, a put spread at the exact same strike as a call, collected whatever I could collect. I collected $1.20. So now I've got an iron butterfly position that expires next week. I've collected on this trade $1 plus $1.23. My max loss is $5. So now my max loss is $2.77. That's worst case scenario right now. If I close this trade out for $5, which is the max that I can close it out for, then I would lose $2.77 on this trade, times 100, of course. But I could close it for less. I could maybe close it for 4. I could maybe close it for 3, depending on where Tesla trades. If the closer Tesla trades to 330 come November 15, the better position I am in, and I can close it for less. So really, right now, I need Tesla to trade around 330 for me to close this trade for hopefully break even or even for a small profit. But at least I know now that my max loss is $2.77. But while I placed this trade here, when I brought up the put side, I decided to sell a call spread a little bit higher. So when Tesla was trading at 335, I sold a call spread at 350, expiring November 15 on Tesla. Collected about $75, I believe, 75 cents. Now this is a little risky because I've got 1 week to go, and who knows, Tesla could jump up through to 350, right? If that happens, then this trade becomes max loss of $5 minus the premiums collected, and then this trade becomes another loser. So this is a bit dangerous, but I did this with the assumption that Tesla went from 240 or 230 to 335 already in like less than a month. I think that's enough, but every time I say that, it just keeps going higher. So this is a little bit dangerous, but I did it to collect more premium to reduce the max loss on this trade here. We'll see what happens. So Uber dropped hard after earnings. So I had a covered call trade at a 31.5 strike. So good news is my 31.5 strike wasn't dangerous anymore because I bought the stock at 40, so I don't want to lose my shares at 31.5. So I keep collecting premiums on Uber. Right now, I sold another call option at a 29 strike, but expiring November 15, so expiring next week. Stock is trading at 27, so I'm hoping that Uber doesn't jump from 27 to 29 in 1 week. Got United States Steel here. My strike is 13, but I bought my average cost is 18.29. Stock is trading at 13.5 right now. I might have to roll the call option. I might have to roll it to December 20th, especially that there's a dividend coming up soon. And usually when there's a dividend, there's a chance that the call option gets an early assignment. So I might lose my shares at 13, but my cost is 18.29. So Monday, I might roll this call option to December 20th, collect more premiums, even if it's at the same strike. But I'll be collecting more premiums and therefore reducing my cost basis on United States Steel. I've got Zillow here that jumped up after earnings. My strike is 34, and that's a strike I'm comfortable with. So if I can roll the call option to the following month, collect it for a premium, for a credit, I'll do it if the credit is worth it. If not, I'll just get my money back, get my shares back at 34, which I'm very comfortable with. I started off this trade with a 34 strike. So this is a perfect covered call trade. Premium several times, never had to lose my shares lower than my cost. I might roll it over for credit though if the credit is worth it, because remember, this is in my margin account, so I'm actually paying interest by owning these shares. So it has to be more than the interest I'm paying. Premium collected from the call option is not more than the interest I'm paying, then I won't do it, of course. So in my TFSA, I only have covered call trades because you can only write covered calls in registered accounts in terms of premium selling strategies. So you can't do credit spreads in registered accounts. So I've got Afria, I've got Bed Bath & Beyond, which I've rolled over to December 20th, collecting another premium. I've got CHK, which expires next week. The stock is at 90 cents. I bought it at 2.8. That's why I say I'm no longer gonna do covered call trades on stocks because of scenarios like this that just keeps happening. I had a 1.5 strike, collected a premium at least. It's gonna expire worthless. So at least I get to keep that, but I'm in trouble with the stock position itself. I've got FCX that I've rolled over to December 20th for a premium, so that's good. Keep collecting premiums on that. I've got Grubhub that I bought at 70. Right now it's trading at 36, but I sold a call option at a 40 strike. So I've got this risk that Grubhub goes above 40, but I've got a week to go. Right now it's at 36, so hopefully my call option expires worthless and I'll sell another call option the following week or the following month. I've got Halliburton expiring next week, 21.5 strike. The stock is trading at 21.2, so it's kind of close. Of course, I'm going to roll it over because my price is 23. My cost is 23. So depending on where Halliburton is trading come Friday, I'll either keep the same strike or I'll move a strike higher. I've got IMGN, which expires January 17 at a 3 strike. I collected 25 cents, but the stock is already at $3.35. This was a really bad trade to begin with. I'd be happy if I can get out of it with $4. NEO, amazing NEO. Bought it at 5, dropped all the way down to 1.5. Sold a call option at 2. This week, actually, NEO went above my strike of 2, but right now it's trading at 1.98. I need it to stay below 2 come November 15, so I don't lose my shares at $2, or at least I'm not forced to buy back the call option. I don't want to buy back the call option, and I don't want to lose my shares at $2, but I'll have to roll it over to the next month, most likely, for a premium, for a credit. The Qs, so this is what I want to continue doing. I want to do covered call trades on ETFs and ETFs like the Qs and the SPYs and the IWMs. So I've got 100 shares of the Qs that I bought at 191. It's trading right now at 201. Now, of course, in this case, it wasn't a benefit for me to sell call options because I would have made more by just keeping the shares. I would have made $10 of profit. But I don't know that it was going to go to 201. I had no idea. In fact, when I bought it at 191, it dropped to 185 almost, 184. So I don't know where the stock is going, and I don't want to predict where it's going. I don't want to think about it. I just want to make consistent income every month. So I bought the stock at 191, but since I bought it, I've been selling call premiums every week. But right now that the stock's at 201, rolling over the call option at the same strike becomes harder because there's less extrinsic value. There's less time value when your option is deep in the money. So when I first started off this covered call trade, I was collecting $150 per week. But then it kept dropping and dropping and dropping because the ETF keeps going higher. So my call premiums, the extrinsic value in the call option goes down. At some point, I think I collected $30 per week instead of $150. So here you can see that when I initially, this here shows all my trades on the queues. So when I initially opened the trade on September 20th for 1 week, expiring September 27th, I bought the queues for $191, but I actually only paid $189.50 because I sold a call option against it right away. So as you can see, the difference is $150. $191 minus $189.50. So I collected, on the first week, collected $150. Second week though, I collected $66. Third week, collected $55. Fourth week, $130. Fifth week, $95. Sixth week, $50. And then seventh week, another $50. But now, this week, I went to December 20th because if I had continued 1 week, I would have collected $16. So I felt like that was too little. I decided to go to December 20th. So instead of going weeklies, I went all the way down, all the way up to December 20th, but I collected $196. So it's like collecting $32 per week, but it's a guaranteed $32 for the next 6 weeks. So now what I really need now is, between now and December 20th, is for the queues to slowly drop back down. And I've got Teva that I've rolled over to a 10 strike. I had a 9.5 strike on November 15. I rolled it over to December 20th at a 10 strike, collected more premium on that. So I've had Teva for a while, but as you can see, I've collected, this page here only shows the past 3 months. So in the past 3 months, even though I'm down on Teva a lot on the stock itself, but I'm still collecting premiums on it as much as I can. So you got 6 cents, 7 cents, 19 cents, 21 cents. So it's better than doing nothing. So that's about it for my portfolio review. So you can see that mostly my plan right now in my margin account is to trade credit spreads on hopefully the indexes. So S&P 500, Dow Jones, the Nasdaq, the Russell 2000. And in my registered accounts is covered call trades. Now I've got some old covered call trades on stocks. I want to get rid of them to hopefully continue with ETFs. And if I am going to do covered call trades on stocks, it's going to be stocks with market caps over 200 billion. So like Visa and MasterCard, Facebook, stocks that I know in the long run are always going to go up with the market. Premiums might be lower compared to other stocks, but at least the stock itself is safer. I don't have to worry about ending up with a stock that's down 50%. But unfortunately, Visa and MasterCard, all these good stocks are high right now. I find them expensive. So waiting for them to come back down so that I can buy them. Alright, so if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.